What's going on, everybody? Chris here from Project Option, and in this video we're going to talk about market orders, limit orders, GTC orders, and stop loss orders. Now keep in mind there are more order types than just these four, but these are the most common ones. So let's go ahead and get into it. So as we can see here, we have the market order, the limit order, the GTC order, and the stop loss order. So let's go through these one by one really quick. So the market order is an order that guarantees an immediate fill, but not the price in which you're filled. So as a result, market orders tend to fill you at prices near the asking price when you're buying and the bidding price when you're selling. However, market orders don't have to fill you at the asking price when you're buying or at the bidding price when you're selling. You could actually get filled at worse prices than those. So for that reason, we generally don't recommend using market orders unless you absolutely have to get out of a position. But even in that case, there are better alternatives to using a market order. Next up, we have the limit order, which is an order that is used to execute a trade at a specific price or better. So let's say a stock is trading at $50 and you want to buy it when it hits $49. If you use a limit order with a price of $49, you won't buy the shares unless you can buy them for $49 or cheaper. Next up, we have the GTC order, which is a good-till-canceled order. Now, GTC orders are typically limit orders that remain active until canceled. However, we'll talk about later that some brokerage firms actually do limit the amount of time that you can have a GTC order open. So while the name is good till canceled, some brokerage firms will cancel these for you automatically after maybe 30 or 60 days, depending on the specific brokerage firm. And lastly, we have the stop loss order, which is used to immediately execute a trade when a stock or option trades at a specified price. So now that you know the basic order types, let's go ahead and look at some examples of market, limit, and stop loss orders so that you can better understand each order type. So in this example, we're just looking at your likely fill prices for a market order. So in this case, the asking price is $5.50 and the bid price is $4.50. So if you routed a market buy order, it's likely that you would get filled near the asking price of $5.50. On the other hand, if you routed a market sell order, it's likely that you'd get filled at the bid price of $4.50. Now with a market order, there's very little chance that you get filled near the mid price of $5 because that's more difficult of a fill. Market orders are going to fill you at the easiest price possible, which is going to be the most unfavorable price for you. Alright, and in this example, we're looking at a limit buy order. So let's say the current price of a stock is $50 per share and you wanted to buy the stock when it reached $42.50. To accomplish this, you could route a limit buy order with a specified price of $42.50. Now this order will not be filled unless your fill price is $42.50 or lower. So $42.50 or better. Since you're buying, a better price would be lower. So in this case, $42.50 is your limit buy order. You will not get filled unless the fill price is $42.50 or lower. Now in this example, you're trying to buy shares $7.50 lower than the current stock price, and that move probably is not going to happen in a single trading day. So you might have to use a GTC buy order on this, and maybe that order will stay active between 30 and 60 days depending on your specific brokerage firm. Alright, in the next example, we're looking at a limit sell order. So let's say the current price of a stock is $40, you own some shares, and you want to get out when the stock price is $45 or higher. To accomplish this, you could route a $45 limit sell order, and in that case, you will not get filled unless you can sell the shares for $45 or higher. Alright, let's take a look at some stop loss orders. So in this example, we're looking at a stop loss sell order, which you would use when you want to sell an asset when it reaches a certain price. So let's say you bought some shares of stock for $50 per share and you want to cut your losses if the shares trade down to $40. So to do this, you could route a stop loss order to sell the shares when the shares hit $40. So if you route this stop loss sell order, if the stock price falls to $40, a market order to sell the shares will automatically be executed and you'll be selling those shares at whatever the current market price of those shares is. Alright, in this example we're going to look at a stop loss buy order. So let's say you short some shares of stock for $70 per share, but you want to buy those shares back if the shares rise to $75. So to do that, you could use a stop loss buy order with a specified price of $75. If the stock price rises to $75, a market order to buy back the short shares will automatically be executed, and you'll be taken out of those shares at the current market price. So using stop loss buy orders is a way that you can, cover short shares of stock or a short option when it rises to a certain price. Alright, so let's go ahead and discuss the main concepts that you've learned from this video. So the first is that market orders guarantee immediate fills but not the fill price, and therefore in our opinion market orders should be avoided at all costs. Limit orders only execute if the trade can be filled at a specified price or better. Therefore, we think that limit orders should be used 95% of the time because your fill prices are going to either be what you wanted them to be, or they'll be better. GTC orders remain active until canceled or have been active for the brokerage firm's maximum allowable duration. And lastly, stop loss orders execute market orders when the stock price or option price reaches a specific price. However, be wary of the fact that stop loss orders can be used without a position in the stock or option. So for example, if you don't have short shares of stock and you implement a stop loss buy order, you will automatically buy shares of stock when the stock price rises to a certain level. Now for most people that won't make much sense because a lot of people would prefer to buy shares at a lower price as opposed to a higher price. So just keep that in mind, and if you have a stop loss order on shares you own and you end up selling those shares, be sure to cancel the stop loss order because that could cause some unwanted problems in the future. Alright, well that wraps up this video. Thanks so much for watching, everybody. If you enjoyed this video and you found it informative, please go ahead and subscribe to our YouTube channel so that you can consume all the videos that we come out with in the future.